Hello and welcome to the paid weekly recap for the week ending March 27th, 2026. I'm Keith Harwood here for Yellow Tunnel, and also pictured is Vlad Karpel, the CEO and founder of Yellow Tunnel and the creator of the artificial intelligence behind the paid system. Normal disclosures before we get started. Options involve substantial risk and are not suitable for all investors. Yellow Tunnel and myself are not investment advisors and not registered with the SEC nor FINRA. The information in this presentation is for educational and information purposes only and should not be considered trading advice. Myself and/or the team at Yellow Tunnel may have a financial interest in the securities presented and the trade ideas. I also urge you to check out the characteristics and risks of standardized options available at the highlighted link, and if you need more time with the disclosures, please go ahead and pause the video now. So for this past week, we've had a continuation of concerns with the Middle East geopolitical situation, and it's causing a rally in the 10-year yield. As traders and investors consider the inflationary impacts of the tensions and the conflict in the Middle East, we've gone from a point of expecting Fed rate cuts to potential Fed rate hikes to spur inflation. Now, this creates a little bit of a problem because we have an economic weakness as a result of the conflict, and now we've got inflation. Traditionally, when the economy is weak, the Fed looks to lower interest rates. That helps spur economic growth. When there's inflation, they may need to raise interest rates in order to combat that higher inflation. The Fed is in a difficult decision. We've got a weakening economy due to the conflict. We've got inflation due to the conflict. So which direction do they go? And that creates uncertainty and concern for the market. Now, a lot of times this is referred to as a stagflationary economic condition. And that's a very bad word for the market. And so this week we saw that bad word really trigger some negativity. On Monday, there were expectations that maybe there was some progress. We saw some, negotiation bullet points and things sent over to Iran. They basically said, we'll take a look, but we won't sit down and negotiate, which tells us, I think, that, we may still be far apart. And the market started to grasp onto that by the end of the week, recognizing that a deal is not imminent. And if a deal is not imminent, there's a chance for escalation. And if there's a chance for escalation, it's a longer drawn out process. And a longer drawn out process is worse for the economy and can create further inflation. We see a large rally in oil prices, for example, showing that inflationary concern. So the market fell. No other way to say it. And in fact, this time, we pushed below that 200-day moving average, bounced back up to it, and then immediately fell off. So we're behaving in a bear market condition. The 200-day moving average is a spot that a lot of longer-term investors use as an indication of just generally having a bull trend. And so once we get below it, longer-term investors can oftentimes start to reduce positions. I think the one thing the bull has to grasp onto right now is that with this lower RSI, we've got a very oversold condition. That can create a bounce, but it doesn't mean a rally. We need a true fundamental change, I expect, in order to see a rally. Tech took it hard as well this week, got back down to that same 30 RSI, same idea, bouncing back towards that 200-day moving average before falling. We're not seeing any real signs of momentum to the upside, and in fact, we're starting to see increased momentum to the downside. Tech names, particularly smaller tech names, traditionally prefer a lower interest rate environment, easier to raise capital for that growth. And seeing this higher interest rate can be very concerning for a lot of the tech sector. These are also generally spots where we see greater risk being taken. So when we see a risk on market, tech tends to lead. Right now, tech's not leading, and it really hasn't been for months. Small caps have been leading. Now, small caps on a relative basis look a little bit better. Now, a portion of small caps is the energy sector, and the energy markets do generally look good. With oil prices higher, a lot of oil companies at any point in the production cycle seem to be doing fine. Higher energy prices, potential for higher margin, whether you're a pipeline or a driller or anything else. All of these oil names, the oil producers, the energy companies, etc., the gas companies, all seem to be doing just fine. And that seems to be holding up the Russell 2000 a little bit better. But on Friday, we saw financials break through recent support. We saw a lot of weakness across the board. Number, if not most stocks now are below their 50-day moving average. A lot of signs of just general bearishness. And so it's a very difficult market to get into the long side unless you're into the energy sector. Particularly with the VIX now above 30 and settling above 30. It's been marching higher. It's been a little bit under where I would have expected given current market conditions. And even still, I would say that this VIX may need to be higher than it is right now. Implied volatility, a bit low. The fear in this market is a bit constrained relative to where the market behavior really has been. Now, a lot of this is driven by money flow. Consistently, we've seen on these falls in the market that put skew is coming down, and that's an indication that there are more sellers than buyers on the put side of the broad market. Effectively, people saying, if we get low enough, I'll buy this market, or I'll take my profits on my hedge. Now, if we have unhedged longs, that could create that capitulation selling. We haven't seen signs of true capitulation in the most recent portion of this fall. And so once we see that capitulation, that may be the ultimate sign of the bottom or an update on the fundamental side that triggers a viewpoint that things are going to start to improve. Now, all that said, we did have a paid trade this week. We added into KMI on Thursday using some shorter term AI signals. Now, KMI is in that energy sector, and it's been generally strong, and it's been lagging a little bit of the energy sector on the whole for the last few weeks. It had a nice run in February, as many energy companies did. Once the conflict started up, KMI got widely forgotten. On Thursday, it started looking for a breakout, getting above the recent highs, pushing for some upside. Topping out early on Friday before the broad market weakness actually pulled it back to unchanged. And we entered into some long calls for paid on Thursday midday, the April 17th $34 calls, and exited half the position on that spike up towards the highs. Managing these trades is key. Setting and forgetting can work when you catch trend, but when we've got this market volatility, setting price targets, profit targets is often beneficial. So rather than just leaving the trade for the full week, waiting to see how things play out, we exited half the position once we reached a 50% gain. That way we locked in some profits and reduced the total risk of the trade. With the stock falling back to nearly unchanged by the end of the day on Friday, that turned out to be a very strong position or a strong decision, a smart decision. We'll look towards an exit in the remainder if we get a big run next week, or if we just get to our normal time frame of about a week of holding period. But so far, so good in KMI. It's good to get a small win there, given the market, or a good win at 50%, given the market conditions overall. Not a lot of long options or long stock biases are working right now, but staying within that energy sector and just following where the money's going continues to be a strong play. So we'll continue to look for new ideas this week for both paid as well as for the live trading room. Please make sure you join us in the live trading room. We talk through all sorts of market conditions, morning bell from 9:15 till about 10:15, 10:30 Eastern time, closing bell from 3 to 4. Vlad and I are always here to talk through how we're approaching the market, how to manage portfolio risk, and everything else that's really relevant in the current market setup. Portfolio risk is a big thing right now. How do I manage a drawdown if I haven't done anything till this point? Should I be hedging? Should I be adding? Should I be selling? Well, ultimately, that's up to you. But how am I looking at it? How's Vlad looking at it? How are we approaching this market? And how are we approaching a long overall investment portfolio versus a trading portfolio versus anything else? And we'll always look at the technical setups and the AI setups for any stocks you guys may be interested in. If you have separate questions, you can always email us. I'm Keith at yellowtunnel.com. Vlad is Vlad at yellowtunnel.com. We'll see what this week brings, but I'm sure that at the very least, we can expect that it's not just going to be quiet, at least for the market, because quiet on the geopolitical front could create some big moves in the market. And if it's updates on the geopolitical front, could also create some significant moves either to the upside or down. So should be an exciting week ahead. Shortened week with 4 trading days. Friday's market's closed. Keep that in mind as well. And looking forward to updating you all on how things are progressing throughout the week. Thanks again.